Hey investors, Happy New Year. It's finally 2023. The bad year that 2022 was is over. I'm more confident on the stock market this year. Last year was a very bad year for Project 1 Million. It wiped out a lot of the gains that we had made over the last few years. I'm confident that this year will be better. I expect the market to be at least up between 10 to 15% this year. I don't think interest rates will continue rising indefinitely, but of course, we have to be cautious. Let me get into the portfolio in more detail. So, this is how the portfolio looks like at the start of 2023. So Google is our top position. It makes up about nearly 17% of the portfolio. Next up is Amazon at about 13%, followed by Intuitive at 9.39% and Meta at 7.91%. So in total, these four positions make up about 47.41%, almost 50% of the portfolio. These stocks have been my top holdings over the last 4 years. They haven't really changed much, except this year Amazon has fallen quite a bit. I think nearly 50% or even more, slightly more than 50%. And it used to be about 20% of the portfolio, but as you can see now, it's about 13% plus. Intuitive has done pretty well. It used to be about 5 or 6%. Now it's about 9%. So, I mean, you could say that I bought some of these companies at high valuations, perhaps Amazon, especially based on the price to earnings ratio. But the counter argument to that is Intuitive Surgical. Intuitive Surgical has always been expensive and has always had a high PE, but it hasn't fallen as much. So I think it has to do a lot with market sentiment, market momentum as well, and not just the PE ratio. But I'm still very bullish on all these companies. Even on Meta platform. Meta platform has made this pivot towards the metaverse, and there's a lot of uncertainty whether it will be successful. But when I bet on Meta, I was betting on Mark Zuckerberg. I think he is a brilliant person. I think that if he feels that the metaverse is not working perhaps this year or by next year, I think he'll come up with something else. He'll come up with a better plan for Meta. And of course, Meta has this very strong social network business, which I still think will hold steady in the coming years. And there are potential outliers in terms of performance with some of the under monetized products like WhatsApp or even Messenger. I'm a bit more bullish on WhatsApp, and I think Instagram can take market share from TikTok as well. And then there are of course rumblings about whether TikTok will be banned in the US, and I think that will be another bullish signal for Meta. Visa and MasterCard have held up pretty well. Alibaba, well, is fallen a lot. I used to complain about the Chinese government and causing my Alibaba investment to fall. But, I mean, this year, a lot of other big tech companies have fallen as much or even more than Alibaba. I'm still holding on to Alibaba. I think the delisting threat has significantly diminished. I think Alibaba can definitely recover. It's still a wonderful business. It has Alipay, and then it has the commerce business, and maybe the cloud business is not as lucrative as before, or it doesn't have as much potential as before. because more people are suspicious of Chinese tech. And also, I think the cloud business doesn't have access to a lot of high-end chips now. But I think Alibaba can still hold steady. I think the antitrust movement in China has also diminished. So I think it can prosper a bit more this year. Adobe is another company that has fallen quite a lot. I expect it to recover quite a bit this year. I've highlighted some stocks in yellow because I think these stocks have fallen quite a lot and have a lot of potential to recover this year. Nike has fallen quite a bit. Teladoc has fallen a lot. It looks pretty cheap to me. I think it can recover. PayPal I think can recover as well. You can see the allocations over here. Upwork has fallen quite a lot. I made a lot of mistakes this year with put options and companies like BigCommerce. I bought too many or I sold too many put options on very low quality companies. So I'm going to be much more cautious about selling put options on low quality companies. I think the S&P 500 can recover at least 10 to 15% this year. DocuSign can recover. Carnival was another bad put option. I'm still stuck with the shares, as you can see. I think Airbnb can recover. Twilio I think will recover. Square, Block I think will recover. Salesforce too I think it will recover this year. I'm interested in CrowdStrike. It still looks a bit expensive to me. If it falls more, I might buy more. I think Micron can recover. It's in the midst of a very severe downturn in the semiconductor industry, but I think it has potential. I think the cybersecurity ETF too has fallen quite a bit. I think it will recover. I've highlighted some stocks in red because these are potentially or they have a potential bankruptcy risk. Beyond Meat is one of them. Fiverr and Intel, and a new one for the portfolio is Zim Integrated Shipping. I'm still studying the shipping industry. I'm still trying to understand, but it looks very cheap to me. It gave out a hefty dividend as well recently, so I'm holding on to it. I think I'll probably buy a bit more if it keeps falling. Intel I think can still be a turnaround play, so let's see how it goes this year. Peloton I think it probably will not go bankrupt, but it's not going to do very well. Probably a very bad investment on my part. So I have a lot of put options on some of these companies like Peloton and Nanox. Nanox is one that I probably have to what I so-called refinance. I'll need to extend the duration of the expiry date so that it doesn't get assigned. This end of Jan is when it was supposed to get assigned. I've done that for a lot of other companies as well, like Lemonade and Snap, where I sold put options prematurely. You can see these other holdings. Carvana is another potential bankruptcy risk. Do I think Carvana will go bankrupt? Well, I think it depends on the interest rate environment. If the interest rate environment is still 5%, in the second half of this year, then probably Carvana will go bankrupt. But if we get a reduction in interest rates, in the first half of this year, then probably Carvana can recover. I like Metapod. I still think there's potential in it. I might buy a little bit more, but I have sold a put option on it, so maybe I think that's the extent of the exposure I want. Farfetch has been a disaster. It's fallen so much. I sold a put option on it. It got assigned, and I had to resell a put option for a longer expiry date. So I'm putting off a lot of these expiries of these put options. because I don't want to have any negative cash position because the interest rates are so high. I'll pay a lot of margin interest on that, so just pushing out these expiry dates as far as possible. But I think Farfetch, the original idea was that, it was like a Louis Vuitton type of company focusing on the luxury market. I think it can still recover, especially with China opening up. Invite is another bankruptcy risk. You can see the other stocks we hold. So our total portfolio value is about 209,000. And this is what it comes down to, really, the performance. We were doing so well in 2019, 2020, even 2021 was decent. But 2022 has been a terrible, terrible year. We're down nearly 40% and nearly 47% if you take out the leverage. So leverage works two ways. In a down market, it will magnify the losses. But hopefully this year with an up market, it will magnify the gains. So maybe we can outperform this year. So over the last 4 years, the annualized return, this is an approximate value because I took this from the October update. It was pretty much similar, so I didn't really amend it. So it's roughly about 8.55% over the last 4 years. If you take out leverage, it's about 4.51, which is really terrible. But I think some of these put options won't be assigned, so I think it's roughly the true value is about 6% plus, I think. But we still severely underperformed the S&P 500, which has done about 13% if you reinvest the dividends over the last 4 years. So that's severe underperformance. It just took 1 year for me to really doubt my ability to beat the market. The first 3 years I was roughly consistently beating the market, and I was getting very confident about my stock picking abilities. But this year has been the complete opposite. So the main lesson for me was I underestimated the risk of interest rates. I knew that Warren Buffett always said that interest rates were like the law of gravity in the stock market. But this year was when it really hit home. So, with interest rates rising so much, stocks became less valuable, basically. So I think I should have held more cash. I don't think I would have made different investments. It will still probably be the same top 4: Amazon, Facebook, Google, Intuitive, Visa, Master. But I think perhaps I could have held more cash. I definitely should have sold less put options on lower quality companies. Should have been more cautious, less greedy in a bad sense. I think those are the main takeaways for this year. On the bright side, cash is not trash this year. It's definitely gaining good interest. Even in the bank account, sometimes you can get up to 5%. I think that's a decent interest. Let's see how long that lasts. I'm going to be more cautious. Can interest rates go to 10%? That is the next question. I doubted that interest rates would go even to 5% from when it was at 0%, but it has. Then the next question is whether it can go to 10% from 5%. I doubt very much that will happen. That will cause a severe economic recession, I think, even a depression. Many people have gotten used to low interest rates. They've taken out mortgages, taken out loans based on those low interest rates. If selling goes 10%, I don't think they'll be able to service their mortgages or their loans. We saw a preview of that when the Bank of England tried to calm the markets. I think it restarted quantitative easing when interest rates were rising too fast because a lot of pension funds could go bankrupt perhaps. So that kind of shows that we have reached the upper limit, I think. Perhaps I think inflation has also come down, so the political justification for rising or raising interest rates is definitely a much lower. I think the political environment has also turned a little in the US. It's shifted more to Republican, and they tend to be more friendly towards the stock market. Let's see how the presidential run turns out. That might be another catalyst for the stock market as well. So I'm really behind the S&P 500 after 4 years. Let's see over the next 4 years whether I can catch up and finally beat the S&P 500. I still think I can. I gotta be more diligent in my research. Gotta be more cautious in my valuations. And I think I gotta learn much more from other good investors. So let's go through what I've been up to in the last 3 months since the last update. So let's go through the history portion of the portfolio. So you can see here I sold this put option on Carvana 2.5, sold this put option on Upwork. I just scrolled through this pretty fast. I've been paying more interest, $19. I think that time I had a negative cash position. Sold this Beyond Meat put option, sold Teladoc put option, bought Simo for the arbitrage basically. So Teladoc put option. I think this was when I was trying to extend the expiry date of some put options that got assigned. So put option on Wish, bad decision. Bought Carvana, you can see at what price, so shows what I know about valuation. This is what else. So Meta put option. To see some stocks got assigned, and then I try to extend the expiry date. So I was doing a lot of firefighting in October basically, because a lot of put options went bad basically. Especially when the cash position goes negative, that's when I have to sell more put options to raise cash. There was only once I think I added some cash this year. I think that was a mistake too. I think I made a bad bet on Alibaba. So I'll just run through this quickly so you can get an idea of what I've been up to. So a lot of very out of the money put options for Meta because it fell so much. You can see the rest of the action over here. Had to do a few extensions of Innovative because it kept getting assigned, although it was not due to get assigned yet because the expiry date was in end of Jan this year. But the American options, they can be assigned at any time. Paying margin interest. So we can look at what else went on. This was a dumb thing, I think. Reorganization fee. What is this for? I don't know. Mandatory reverse split. Not sure why I get charged these reorganization fees. Name change. get some dividends, pay some tax, cash in lieu of fractional shares. I got $22 here. I sold Tesla puts for the first time because it fell quite a bit, but these are very far out of the money kind of put options. I might even buy some Tesla shares if it keeps falling. I'm confident about the autopilot program for Tesla. That's basically the main reason why I would buy Tesla shares. So you can see I was selling a lot of put options here, minor put options, I would call them. Micron, $17.5 strike price, you get $33, those kind of things. But Palantir recently, I think it fell quite a lot. So some tax issue going on over here. Margin, good. I don't want to pay too much margin. So you can see the options are still quite significant. So they still have the potential to explode or cause the portfolio to implode. But I think they're under control. I know a lot of these that will expire on 20th Jan 23 are gonna expire worthless, except two. I think Nanox, I need to extend the expiry date. Also Good RX, probably on track as well. And then a bunch of expiries come due in middle of the year, and then a lot more at the end of the year or early next year. And some have even gone out to early 2025. But I think most of these will expire worthless, so I won't be assigned. But you never know, something could backfire. Like for example, Beyond Meat, it could go bankrupt. Twilio could fall, although I don't think it will, but it could fall significantly. Yep, you can see what else I have over here. So those are the put option contracts, and that's what I've been up to in the last 3 months. So this is the usual performance table that I show. So for the last 1 year, the only one that's positive is Berkshire Hathaway. What a year Warren Buffett has had this year. At 92, he's outperforming the market. Great performance. S&P 500 is down about 19% plus. Triple Q is down about 33%. Scottish Mortgage is down 46%. Barron Fifth Avenue is down 50%. Berkshire Focus and ARK are down about 65 to 67%. So ARK has not had a good year, and over the last few years also is probably outperformed the S&P 500. So this is the table for Fundsmith. So Fundsmith will probably end up this year, I think, about minus 18 or 19%, so about level with the S&P 500. Over the last 4 years is done about, according to my calculation, about 10.3% annualized. And this is despite the fall in the pound. So I mean, a lot of this gain includes the fall in the pound as well. So even some of the top managers like Cathy Wood and Terry Smith have underperformed. So I can take a bit of comfort from that, but of course it doesn't really matter whether other managers underperform or not. The main goal is for me to outperform the S&P 500. So that is still the goal. I think Warren Buffett over the last 10 years is beating the S&P 500, and so my goal is to also beat the S&P 500. So that is the update. It's been a difficult year, but I look forward to a more promising year. Thank you for being part of the journey. Let me know your comments, let me know your thoughts or your suggestions. I'll keep to doing quarterly updates. If you'd like to see more videos, also let me know in the comments. And with that, I'll say thank you and have a great year ahead.